Crypto is the most potent narrative vehicle ever created because it combines three profound human stories into one. 1. The rebellion story. The 2008 financial crisis left a generational scar. Here was Bitcoin, a currency created by an anonymous entity, free from banks, governments, and the corrupt intermediaries who crashed the world. It was the ultimate protest. 2. The gold rush story. The early tales weren't just wealth, but asymmetric wealth. The pizza bought for 10,000 BTC. The forgotten hard drive with a fortune. The college kid who became a millionaire overnight. These aren't just anecdotes. They're modern parables that whisper, you could be next. Your obscure hobby could be your ticket. 3. The technological rapture story. This wasn't just money. It was the foundation of Web3, the metaverse, decentralized autonomous organizations, DAOs. You weren't just buying a token. You were buying a stake in the future of the internet, art, finance, and human organization itself. To question it wasn't to be skeptical. It was to be a Luddite, blind to the inevitable. This is the environment you enter. You are not logging into an exchange. You are stepping onto a battleground of competing myths. And your first, most dangerous enemy is the part of your own brain that is wired for just these kinds of stories. The neuroscience of FOMO, fear of missing out, isn't just an emotion. It's a neurochemical event. When you see a chart screaming upward, read a tweet about life-changing gains, or watch a friend's portfolio multiply, your brain's reward system, the ventral striatum and prefrontal cortex, lights up as if you yourself are earning that reward. You experience a vicarious dopamine hit. Then comes anxiety. The anterior cingulate cortex registers a social threat, the threat of being left behind, of watching the future happen to others. To resolve this cognitive dissonance, your brain pushes you toward action. Any action, buying resolves the tension. It feels like a solution, even when it's a problem. My friend Leo never stood a chance against this neurology. He entered with intellectual curiosity, but the moment his first trade turned green, the story became personal. He was no longer an observer of the narrative. He was a protagonist. And once you believe you're the hero of the story, you stop seeing the traps. The illusion of knowledge. Leo's second mistake was a category error. He confused information with understanding and activity with asterisk competence. He became a master of the lexicon. He could talk about hash rates, consensus mechanisms, and elliptical curve cryptography. He joined Twitter Spaces and Discord servers where a new language was being formed in real time. GM, WAGMI, and GMI-based Alpha Deegan. Mastering this language gave him a powerful sense of belonging and insider status. It created what psychologists call the illusion of explanatory depth. You feel you understand something deeply because you can fluently discuss its surface features. He spent hours a day on what he called research, charting, technical analysis. He saw patterns everywhere. Head and shoulders, cup and handles, bullish flags. He drew Fibonacci retracements and RSI divergences. What he didn't understand was that in a market overwhelmingly driven by sentiment, hype, and whale manipulation, Tia is often little more than sophisticated astrology. It gives the illusion of predictability to what is fundamentally chaotic. It makes you feel like you're reading the market's mind, when you're often just reading its last deceiving move, white papers and roadmaps. He read documents filled with grandiose promises, leveraging cross-chain interoperability to create a vertically integrated DeFi stack for the democratization of yield-bearing synthetic assets. Much of this is what insiders call word soup, deliberately complex jargon designed to dazzle rather than inform, to obscure a lack of actual utility. Following the smart money, he tracked blockchain wallets of venture capitalists and influential figures. If they bought, he wanted in. This is a greater fool theory in action. You're not buying because you believe in the asset's value. You're buying because you believe a bigger fool will buy it from you at a higher price. When you're following the so-called smart money, you must ask, are they investing for the long-term fundamentals, or are they pumping a token they receive for free, planning to dump it on retail investors like you? Leo built a towering palace of knowledge on a foundation of sand. He knew everything about the markets, the noise, the narratives, the price action, and almost nothing about the actual value of what he was buying. When the storm came, the palace collapsed instantly because it had no load-bearing walls. The 4 horsemen of your portfolio apocalypse. Trading psychology is the study of how you lose to yourself. In crypto, these internal enemies are amplified by volatility, anonymity, and the 24/7 global nature of the market. Let's name them. 1. Greed, the shapeshifter. Greed is the most insidious enemy because it rarely looks like naked avarice. IT wears many disguises. The disguise of conviction. This isn't greed. I just have deep conviction in the project's vision. You hold through 50% dips, then 80% dips, citing diamond hands as your thesis evaporates. The disguise of patience. I'm not selling. I'm waiting for my price target. But when you hit that target, greed whispers, what if it goes 2x more? And moves the goalpost. You end up watching profits vanish, trapped by your own ambition. The disguise of rationalization. I'll just take out my initial investment and let the rest ride. This is smart in theory. In practice, when the rest is pure profit, you emotionally detach from it. It becomes house money, which you're far more likely to gamble with recklessly. Money is money. Its origin story doesn't change its value. 2. Hope, the quiet killer. Hope is the emotional airbag that deploys after a crash. IT softens a blow, but if you don't disconnect it, it will trap you in a wreck. After a catastrophic loss, hope manifests as the HODL fallacy. If I just don't sell, it's not a loss. This ignores opportunity cost and the very real possibility of a project going to zero. Holding a dead project for years isn't discipline. It's a financial coma, averaging down on a sinking ship. It's 80% down. It's a bargain. This is a valid strategy for fundamentally sound assets in a temporary downturn. It is a catastrophe for broken projects. You are throwing good money after bad, trying to prove your initial decision was right. You're not investing. You're bargaining with the market. The lottery ticket mentality. It's only $100. If it goes to zero, who cares? But if it moons, the scattershot approach ensures you own a graveyard of dead tokens. That $100, repeated across 20 moonshots, is $2,000 that could have been a meaningful position in a real asset. 3. Fear, the paralyzing fog. Fear has two faces, both destructive. FOMO, fear of missing out. We discussed this as the entry drug. It makes you buy high. FUD, fear, uncertainty. Doubt, this makes you sell low. When bad news hits, a hack, a regulatory threat, a founder scandal, the market panics. The narrative turns from utopian to dystopian in minutes. In this fog, your brain screams for safety. Selling feels like putting out a fire, but you're often selling at the absolute bottom to those with cooler heads and deeper pockets who are accumulating. FUD is a clearance sale for smart money, funded by the panic of retail. For ego, the architect of your ruin. This is the most dangerous horseman. Your ego attaches your self-worth to your trades. The need to be right. You fall in love with your thesis. Selling at a loss isn't just a financial hit. It's an admission that you were wrong. Your ego would rather watch the investment go to zero than face that painful truth. You'll find yourself defending a dead project in online forums. Not convince others, but convince yourself. Attribution error. When a trade wins, it's because of your brilliant analysis. When a trade loses, it's because of market manipulation, bad luck, or paper hands selling. This prevents any real learning. You take credit for the winds that filled your sails and blame the storms for every shipwreck. Leo rode with all four horsemen. Greed made him lever up on meme-coins. Hope made him hold moonshot as it vaporized. Fear made him liquidate his entire portfolio in a panic during a market-wide dip. And ego made him do it all again, because he couldn't admit he was just another character in the story, not the author. The environment of addiction. Crypto isn't just an asset class. For many, it's a carefully designed Skinner box. Understanding this design is crucial to maintaining autonomy. The dopamine loop. 1. Variable rewards, the most addictive schedule. You refresh your portfolio 100 times with minor changes. The 101st time, it's up 30%. That huge, unpredictable hit of dopamine trains your brain to keep checking endlessly. 2. The 24/7 casino. Traditional markets close. They force a pause, a chance to breathe. Crypto never sleeps. A life-changing pump or a heart-stopping dump can happen while you're making dinner or in the shower. This creates chronic, low-grade anxiety and ties you to the screen. 3. Gamification. Platforms use confetti animations for trades, leaderboards, badges, and achievements for volume. They turn investing into a video game, obscuring the fact that the points are your actual livelihood. 4. Social proof and tribalism. Being in a Telegram or Discord group during a pump is a potent social high. The emoji spam, the collective countdown, the shared euphoria. It's a digital tribe experiencing victory. This bond makes it incredibly hard to dissent or sell when the tribe is still holding. Leaving the trade feels like betraying your community. The information fire hose. You're inundated with signals, but have no way to discern signal from noise. A tweet from an anonymous account with a cartoon animal profile picture can move markets by billions. You must constantly monitor. Twitter for sentiment and announcements. Discord/Telegram for alpha and community mood. On-chain analytics for whale movements. news aggregators for regulatory threats, price charts on multiple time frames. This creates decision paralysis and chronic stress. You are always on, and a mind under siege makes terrible decisions. The house always wins, invisible costs and asymmetrical games. You think you're playing a fair game. You are not. The architecture of the crypto ecosystem is tilted, often deliberately, against the retail participant. 1. The extractive infrastructure. Gas fees, Ethereum and others every transaction. Buy, sell, swap, stake, cost a fee. In times of congestion, these fees can exceed $100. This turns short-term trading into a mathematical impossibility. You must make massive percentage gains just to break even. These fees are a constant, friction-based drain, a tax paid to network that flows to miners/validators and sophisticated bots. Spread and slippage. The price you see isn't the price you get. On decentralized exchanges, DEXs, large orders move the price against you, slippage. On centralized exchanges, the difference between the buy and sell price, the spread, is a hidden cost. For small cap, liquid tokens, this can be 5%, 10%, or more. You're down the moment you enter. Withdrawal fees. Moving assets off an exchange often incurs a flat fee that is a significant percentage of a small portfolio. 2. The predators in the pool. MEV, maximal extractable value. This is the dark art of crypto. Sophisticated bots surveil the public mempool where pending transactions wait. They see your order to buy a token that's pumping. They front-run it, buying before you, which drives the price up, then selling to you at the higher price. They can also sandwich your trade or cause it to fail, all while stealing your value. This isn't illegal. It's baked into the design of blockchain sequencing. As a retail user, you are perpetually the slowest gazelle at the watering hole. Whale manipulation. A single entity with a large enough wallet can pump a low-liquidity token, create FOMO on social media, and dump their entire bag on the incoming retail buyers, collapsing the price. The charts you study are often paintings made by whales to tell you a story they profit from. 3. The leverage liquidation engine. This is where Leo met his end. Exchanges offer 10x, 50x, even 100x leverage. It's marketed as a tool for sophisticated players. In reality, it's a guaranteed liquidation machine for retail. How it works: you put up $1,000 as collateral. You borrow $9,000 from the exchange to open a $10,000 position, 10x. If the asset moves 10% against you, your $1,000 collateral is gone to repay the loan. The exchange automatically closes your position. You get nothing. The mathematics of ruin. Volatility is the norm. A 10% swing happens daily, even hourly. With high leverage, you are not betting on direction. You are betting on perfect timing with zero margin for error. The exchanges love this because liquidations provide them with guaranteed profit from your loss. The liquidation price is a tripwire waiting for a tremor. The scam spectrum, from rug pulls to slow drains. Not all projects are created equal. Many are created to fail, profitably for their creators. You must learn to recognize the taxonomy of deception. 1. The hard rug pull. The most brazen scam that a team launches a token, heavily markets it, gets it listed on a DX. Liquidity is locked, or so they say. Once a significant amount of money pours in from retail, the developers withdraw all the liquidity from the trading pool the rug, instantly crashing the token's value to zero. They vanish, often with millions. Signs. Anonymous team, copy-pasted website, hype purely on social media, no utility. 2. The soft rug / slow drain. More common and insidious. The developers don't vanish overnight. They remain, but they consistently sell their large free token allocations onto the market, creating permanent sell pressure. Promise endless development that never materializes. Use treasury funds for lavish marketing, which is just funneling money to themselves. The project bleeds out over months, giving holders false hope all the way down. 3. The Ponzonomic scheme. The project's only utility is to bring in new buyers. The high-yield staking rewards of 100% plus APR are paid not from revenue, but from the deposits of new entrants. It works beautifully until the inflow slows. Then the whole structure collapses. Think unsustainable play-to-earn games or DeFi pyramids. 4. The governance trap. A project touts its democratic DAO structure. You buy the governance token to have a say. In reality, the founders retain control through opaque voting mechanisms, multi-sig wallets, or simply by holding a majority of tokens. Your voice is theater. 5. The infinite supply rebase token. A token that automatically adjusts its supply in your wallet daily to maintain a target price. IT seems stable, but your percentage of the total supply shrinks constantly as new tokens are minted for founders and insiders. You are being diluted into oblivion. How to spot them? A survivor's checklist. Team. Are they public with verifiable LinkedIn profiles and real-world reputations? Or are they anonymous NFT punks? Code. Is the contract audited by a reputable firm, not just an unnamed friend of the project? Is the audit public? Utility. What does a token actually do? Does it generate fees, confer voting rights, or is it just a voucher for a promised future? Token distribution. Check the blockchain. Is 40% of the supply in one wallet? Are founders' tokens locked with sensible vesting schedule, or can they dump tomorrow? Roadmap. Is it filled with vague buzzwords, dominate the metaverse, or specific technical milestones? Launch mainnet with zk integration by Q3. The regulatory fog of war. You are operating in a legal gray zone. This creates immense non-financial risk. 1. The sword of Damocles. At any moment, a regulatory body, the SEC in the U.S., FCA in the U.K., etc., can declare a token you hold to be an unregistered security. The result? The token gets delisted from major exchanges. Liquidity vanishes. The price collapses. The project faces years of legal battles. You, the holder, have zero recourse. This is an FUD. It's the ongoing reality for many tokens. 2. The tax nightmare. Every single trade, token A for token B, staking reward, NFT purchase, is a taxable event in most jurisdictions. The computational burden of tracking cost basis across thousands of microtransactions across multiple wallets and chains is Herculean. Getting it wrong can lead to crippling penalties. Many only realize this when the bill comes due. 3. Counterparty risk. Not your keys, not your crypto. Leaving assets on an exchange, a centralized counterparty, exposes you to hacks. Billions have been stolen from exchanges. Bankruptcy. Exchanges can then have frozen withdrawals and gone under. You become an unsecured creditor in a chaotic foreign bankruptcy proceeding. Government seizure. An exchange can be sanctioned or shut down by a government, freezing your assets. Self-custody risk. Holding your own keys in a hardware wallet is safer from counterparty risk, but now you bear 100% responsibility. Lose your seed phrase? It's gone forever. Fall for a phishing scam? It's gone forever. Make a single error in a transaction? It's gone forever. There is no forgot password or customer service line. The anti-fragile mindset. To survive and potentially thrive, you must cultivate a mindset that accepts chaos and uncertainty as the default state. You must become anti-fragile, a concept from Nassim Taleb, meaning to gain from disorder, not just withstand it. 1. Embrace your role as prey. Start with this humbling truth. In the eyes of whales, MEV bots, and sophisticated trading firms, you are prey. This isn't demeaning, it's liberating. The prey that survives doesn't try to outfight the lion. It develops superior senses, learns a lion's habits, and stays the hell out of tall grass. Your survival depends on situational awareness, not brute force. 2. Invert, always invert. Instead of asking, how can I make life-changing money? Ask, how can I avoid losing all my money? This inversion changes everything. Don't seek 100x gems. Seek to avoid the 100x scams. Don't focus on maximizing gains. Focus on rigorously managing risk. Don't ask, what's the best entry point? Ask, what's my unshakable exit plan? 3. Assume you are wrong. Enter every position with the assumption that your thesis is flawed. This forces you to define in advance what would prove you wrong. Is it a price level? A broken fundamental, like a key developer leaving? A timeline? The moment your wrongness condition is triggered, you exit. No debate, no hope, no ego. You have a pre-commitment with your rational self. The ironclad operating system. Your emotions are the virus. Your system is the antivirus. You must build it, write it down, and obey it like code. 1. The Capital Allocation Constitution. The sleep test portfolio percent. What percentage of your total net worth can you allocate to crypto such that if it went to zero tomorrow, you would be disappointed, but you could still sleep, eat, and pay your mortgage? For 99% of people, this is 1 to 5%, not 50%, not your life savings. This is your total crypto risk capital, TCRC. The position sizing rule. No single position should ever exceed a set percentage of your TCRC. A common rule is 1 to 2%. This means if your TCRC is $10,000, your maximum bet on any one coin is $100 to $200. This ensures that even a total loss on a moonshot is a survivable setback, a learning experience, not a life-altering catastrophe. The layer 1 foundation. Allocate a large portion, e.g. 70%, of your TCRC to foundational, blue-chip assets with proven networks and clear utility, e.g. Bitcoin, Ethereum. This is your base camp. The rest can be for exploration. 2. The pre-flight checklist before any buy. Answer these in writing. Utility. What specific current problem does this solve? Not, it will in the future. Team and code. Who are they? What are they built? Is the contract audited? Competition. What are 3 competing projects and why is this better? Tokenomics. How are tokens distributed? What's the inflation schedule? Is there a vesting period for team tokens? My thesis in 1 sentence. If you can't write it simply, you don't understand it. My I am wrong conditions. List them, price X, team abandons project, etc. My exit plan. Profit targets and stop loss. 3. The execution protocol. Use limit orders, not market orders. Set the price you're willing to pay and wait. Avoid slippage. Scale in and scale out. Don't go all in at one price. Buy in portions, e.g. 1/3 at your target, 1/3 if it dips 10%, 1/3 if it dips 20%. Do the same in reverse when selling. This removes the pressure of perfect timing. The stop loss is sacred. Place a hard stop loss order the moment you enter a trade. It is not a suggestion. It is an automatic ejection seat. It protects you from you. The R, the exit, and the power of doing nothing. Knowing when to leave the party. The greatest skill is not buying. It's selling. Greed wants to stay until the music stops. Take profits along the way. Sell a portion, e.g., 25 to 50% of your position when it hits a predefined profit target, e.g. 2x. This returns your initial capital and locks in gains. The rest is free to let ride with less psychological pressure. The sell in May and go away crypto corollary. The market has seasonal tendencies, often softer in summer. Consider taking a literal break. Deactivate your exchange apps for a month. The market will still be there. This breaks the addiction cycle and resets your perspective. The strategic power of inactivity. In a market screaming for you to do something, the most powerful action is often to do nothing. To hold cash or stable coins is to hold optionality. When the market is euphoric and everything is green, that's when you should be selling, not buying. When fear is maximal, the market is a bloodbath and your favorite projects are 80% off their highs. That's when your dry powder is deployed. This requires immense emotional discipline. It feels wrong to buy when everyone is panicking. That's exactly why it's right. What real research looks like. Move beyond charts and Twitter. This is due diligence for the committed. 1. On-chain forensics. Learn to use block explorers, Etherscan, BSC Scan, and analytics sites, Nansen, Dune Analytics, Token Sniffer. Check the token contract. Who holds the supply? Has the team wallet been selling? Track whale wallets are smart money, addresses accumulating or distributing. Analyze exchange flows. Are coins moving onto exchanges, a prelude to selling, or off exchanges into cold storage for holding? 2. Technical due diligence. Read the actual GitHub repository. Is there recent, consistent commit activity from multiple developers? Or was there a flurry of activity at launch and then silence? Read the audit reports. Don't just see that it's audited. Read the findings. Were there critical vulnerabilities? Were they fixed? 3. Economic and game theory analysis. Model the tokenomics. Create a simple spreadsheet. If staking yields 100% APR, how many new tokens are minted per day? What is the sell pressure from those rewards? Is the model sustainable without infinite new buyers? Understand the incentive structures. How are developers, validators, and users aligned? Where are the conflicts of interest? Building a moat of ignorance. You must actively filter the overwhelming noise. 1. Curate your information diet ruthlessly. Unfollow 95% of crypto Twitter. Follow a handful of thoughtful builders, economists, and skeptics, not hype men and chart chillers. Leave 95% of Telegram/Discord groups. They are echo chambers of confirmation bias. Schedule market hours. Check prices 1 to 2 times a day at set times. No constant refreshing. 2. Seek contrarian views. Actively find and listen to the smartest people who are bearish on your favorite project. Don't argue with them. Try to understand their reasoning. If you can't refute their core argument, you shouldn't be invested. 3. The weekend test. If you couldn't check the price or news for 72 hours, would you still be comfortable holding your portfolio? If the answer is no, your investments are too speculative or your psychology is too fragile. Simplify until you pass the test. Epilogue, Leo's piece. Let's return to Leo, now 2 years after Great Liquidation. He didn't leave crypto. He left the war. He still has a portfolio. It's 1.5% of his net worth. 80% of it is in Bitcoin and Ethereum, bought via automatic dollar cost averaging, transferred immediately to a hardware wallet he hasn't touched in 6 months. The other 20% is in 2 small, experimental positions in projects whose technology he genuinely believes in and has spent dozens of hours understanding. He holds no leverage. He uses no derivatives. He checks the price on Sundays over coffee, more out of mild curiosity than anxiety. He reads a few long-form research pieces a month. He has muted every crypto influencer. The noise is gone. The story now follows is his own life, his career, his relationships, his health. Crypto is a tiny, interesting, high-risk experiment on the periphery. It is no longer the main plot. He understands now that the greatest wealth crypto can offer isn't financial. It's the brutal education in human psychology and risk and in your own vulnerabilities. That education cost him a significant sum. For you, it can be free. You don't have to fund the exit liquidity for the next generation of millionaires. You don't have to be the ghost in the machine, the anonymous wallet address that shows a transfer to zero. You can choose to be the survivor. Start by putting down the story they're selling you and picking up a plan you write yourself. Make it boring. Make it disciplined. Make it unbreakable. Then go live your life. The market will wait. And if you've built your system right, it might even make you some money while you're not watching.